For our final panel of the day, we're going to be talking about the state of DeFi and where it's headed. DeFi marks the start of a new financial foundation, open to all, transparent, and programmable. This panel will focus on how we can create a more sustainable DeFi ecosystem given the recent post-bull run suffering that I'm sure we have all felt in our hearts and especially in our wallets. On the panel, we have Dan Smith, Porter Smith, and Allan Gulley. Dan works as a digital asset research analyst at Blockworks. Porter is the head of network operations at A16Z, and Allan is the automated products lead at Index Coop. This panel will be moderated by Shahar Abrams, and please join me in welcoming them to the stage.
All right, last panel of the day. I am super excited for this panel. I love DeFi, and we have three really awesome and differentiated, I would say, voices up here. I'll let you all briefly introduce yourself, but we have the research side, we have product side, and we have the investing side. So I'm going to ask a bunch of questions on DeFi, and our topic today is sustainability. So I think we'll spend a lot of time talking on that. And it'll be awesome, to hear each of you answer from, your own angle in the space. And we'll get a lot of different perspectives today. It's going to be really fun. So let's, I guess, just start off with, what is sustainability in DeFi? What does that mean to you? And specifically, maybe what does that mean to you within the context of what you do, right? So Dan, why don't we start with you? You're on the research side. So give us, the research answer, right? What does it mean to have sustainability in DeFi?
Right, yeah, thank you. So to me, sustainability in DeFi is really building products that people actually need and use. And a lot of that stems around, so from the research angle, a lot of that kind of comes from what system do we build that is sustainable, right? Like, we talk a lot about Ponzi-nomics in DeFi, there's no doubt about that, and that's certainly a real thing, but a lot of those systems aren't sustainable. And a good example of that's obviously Terra Luna. Purely algorithmic stablecoins simply aren't sustastainable. And then you look at more sustainable models, like, okay, well, if your product actually works and solves a problem, like Uniswap, for example, building out a structure that people need and can continue to use is super valuable, right? So, as a research analyst, we look for protocols that actually have a use case to solve a problem and kind of have that product market fit. As well as having sustainable tokenomics built around them. In some cases, you see these protocols that have a token with no real need for a token. So, we can really kind of dive into what that means. But yeah, we look for products that have product market fit and actually have a strong tokenomic structure.
Okay, Porter, let's go to you next. When projects in DeFi, right, or perhaps elsewhere in the ecosystem, come to you guys at A16Z, right? How do you ascertain, right? Are these projects sustainable, or are they, building towards a sustainable DeFi ecosystem?
Yeah, I think mainly it's if they provide real utility value and if people use them regardless of the incentive structure. So a common question that we'll ask is if there were zero incentives going on, would people use the product or not? And then the other thing we look at, we're often in the business actually of investing in people rather than ideas. So you need to have obviously an idea that I think is compelling and that makes sense and perhaps is original. But at the same time, we really look at people, and we want people that will kind of run through walls, because inevitably the problem space will change and businesses will have to change as a result. So the other thing that we generally take a look at is, are you developing or building a product that people will actually use regardless of any sort of artificial mechanisms you might implement to get usage? And then also, who are the people behind the project? That's a really important thing that we spend probably the majority of our time on.
Great. All right. So, Allan, then things come to you, right? You read Dan's research, you get some money from A16Z, right? Now you got to go out and build the thing, right? So, and maybe you can start with, because I think a lot of people here aren't familiar with Index Coop. I think, really cool product, tokenized, like index sort of products across a range of stuff. So talk a little bit first, if you don't mind, about what is an Index Coop. And then if you could answer the question, right, from your perspective as a product guy.
Yeah, happy to do that. So the index coup is technically the index co-op, but I use both terms all the time. So it really
People
just
always
depends on who
say
you're talking
index.
to.
That's what I thought, but people always say, okay.
Yeah, no, I think they left the asterisk out or in between co-ops. Anyways, so it is a cooperative though. It was founded by a number of different partners. Primarily, it was two. There was an infrastructure provider called Set Labs and a data provider called DeFi Pulse, and they came together and they said, we know that indexing and index, financial instruments and traditional finance are one of the biggest markets there is. Let's bring that on chain. Let's do on chain index tokens and structured products so that people can get exposure to DeFi or the metaverse or Web3 data in the form of a tradable index token. So that's really the core of the products that we have. My role as the automated products lead is looking more at some of the still investing strategies, but those that require a little bit more intervention and automation. So we really try to lean into what you can do in a composable ecosystem with smart contracts. And so, but in the sense of what can be sustainable in DeFi, what does that even mean to say DeFi ought to be sustainable? A big part of our business model is for the products that we launch and the AUM that we support, we earn a streaming fee or like a management fee for providing that value, whether it's bundling the tokens or it's automating the strategy. And so having a core business model is important if you're not a public good. And I think that that's where a lot of projects, a lot of bright people, a lot of great ideas kind of find themselves in limbo with, because they have a cool idea or they have value that can be created, but there's not necessarily a viable business model behind it. So that's something that we have to remind ourselves of, and that's something we've always been working towards, is a cash flow positive protocol that is providing value to users and is always trying to find the best ways to take advantage of the best parts of DeFi. And for us, especially when we look at yield products, it's really the compounds, the Aves, the notionals, all these protocols that are out there. They've garnered TVL, they've kept TVL, they're providing real value, and they're either emulating existing financial services or they're creating entirely new ones. And so being able to index those products and not necessarily just their governance tokens is a big step that we're moving in right now.
Cool. Okay. Really interesting. So, Dan, I'm going to come back to you, and I kind of really like Porter's sort of mental model about, okay, if we take away all of the incentives, if we take away all of this stuff and just leave it in a vacuum, does it provide value? Will people use it? I want to talk a little bit about incentives, right? These incentive programs, something very popular in DeFi, right? Many DeFi protocols will try to bootstrap adoption, TVL, right? Liquidity providers by providing lots of incentives, usually in a token that they have created, right? Their own token, right? So when you see protocols, and this is a thing lots of people, some would say blue chip protocols, right, do. So when you look at protocols that have these incentive programs, right, how do you think about that in terms of, is this the right amount of incentives, or is it totally unsustainable? Is it going to lead to a collapse? Is it going to leave investors out to dry? How do you think about that?
Yeah, absolutely. So, DeFi summer really kind of brought the bloom of liquidity mining, where protocols would provide their token to the users in return for actually interacting or using some feature of the protocol. Compound really kind of brought this to the mainstream with they would provide comp tokens to borrowers on their platform. And so, that would drive a ton of borrowing. And in some cases, the borrower would be net positive even though they had to pay a yield to take out that loan. The compound tokens that they were receiving in return for taking out the loan would actually be greater than the interest they're paying on the loan. So this was it kind of brought a bad rap to liquidity incentives. And in a lot of ways, it is like a one of those Ponzi-nomic features that we see out there. And if you're the third fork of the same DEX, and now all of a sudden you're just pumping out liquidity incentives, you're providing no new value, and you're just paying mercenary capital to be there. And so that would definitely be an example of a poorly designed tokenomic structure or a poorly designed protocol as a whole. But there are use cases for liquidity incentives. If you can use incentives to bring long-term users to your protocol, then that's a win-win. And there's actually an interesting example of this. So Curve's whole tokenomic structure is built around sustainable, or attempting to be sustainable liquidity incentives with their vote escrow model. And about 90% of the liquid staking derivative trading volume, so things like staked ETH, Rocket Pool ETH, and so now Frax ETH, about 90% of the trading volume for those assets occurs on Curve and Balancer. And so interestingly enough, these are two protocols that use liquidity incentives, whereas Uniswap, for example, doesn't. The Uniswap v3 model is actually a more efficient model for liquid staking derivatives because liquidity providers don't even need to provide liquidity above that 1.0 range. So it's interesting to see that like a very, very small fraction of this percentage of this trading volume is going on Uniswap. So, while liquidity incentives really aren't like a band-aid or fix-all solution, there are interesting applications where it does make sense to try to incentivize usage to gain market share. If you think about like what what liquid staking derivatives are, that's going to be a continually growing market share. Staking ETH on your own is running your own validator is not necessarily something for the masses. While anybody can do it, it doesn't necessarily make sense in most cases. So I believe that liquid staking derivatives are going to continue to grow, and the fact that Uniswap is missing out on some of this market share will be an interesting market dynamic, considering they do around 60% of all DEX volume. So. I think it comes down to like how you're using these incentives to bring users onto the platform, and will they be there for the long term?
Good answer. So Porter, I want to hear what you think about this as well. When you do have a project that is using incentives, right? Like how do you decide, or how do you ascertain like what is the right amount, right? And where, at what point does it sort of cross the line, of being unsustainable, right? And maybe we can extend that beyond just incentives and maybe other sorts of business practices that a DeFi protocol might use.
Yeah, I mean, it's tough. I mean, one thing that we think about a lot is, going back to the real utility value piece, is there something new or original that's being done here? Or is this an incremental improvement? Or is this a porting over of something that's some sort of, imitation? And oftentimes what we've seen is even though you can fork these protocols, money can move around, et cetera, there is like a powerful brand effect, which a lot of it I think has to do with trust in the smart contracts. So you'll see people kind of coalesce around certain protocols over time, which is what you've seen with a lot of the blue chip DeFi protocols. So that's one aspect of it. I mean, I think the second thing I would say is, in general, moving forward, we're looking to see probably what folks can do in DeFi beyond just on-chain applications. I think over time you'll see a merge with the real world, obviously. And that's a difficult thing to do because anytime it introduces two problems when you have real world assets on chain, it introduces an oracle problem of what's the price, and it introduces generally you can call it a liquidation problem. What happens if whatever's securing a loan, if we're talking borrowing and lending, isn't at the price it's supposed to be to secure the loan? Because now you get into messy real world judicial systems versus automated smart contracts that can just liquidate collateral on chain. And so those are things that over time I think we'll probably see more of, and I'm curious to see how it kind of plays out, because early on it's like a customer acquisition cost, and to use traditional terms, which I try to avoid, but it's similar, right? You're doing some sort of incentive or subsidy to get customers on board your platform in the hopes that they stay. And then the question becomes, well, are they going to stay because the product's good, or were they just tourists visiting because of the subsidies you were putting out? And I think there's probably a very thin dividing line between the two.
All right, Allan, yeah, and as someone that doesn't really use incentives, right, to try to bootstrap user activity or user acquisition, right, like how do you guys try to compete, with these other platforms that are, and that are doing arguably unsustainable, or really towing the line with trying to use native tokens or investor money, or perhaps?
Yeah, so in the early days, this was like DeFi Summer, which was a really fun time. The playbook was to launch a governance token and then just throw it on everything. Just pay people extra to use your product. And we did that for the first index token that we launched, and we realized really quickly that it was a substantial cost that wasn't benefiting the sustainability organization, and it really didn't lead to that much retention in the long term, because a lot of the liquidity that it initially attracted was just mercenary capital. It was just people that were there to provide liquidity, they were hedging it somewhere else, and they were just going to dump whatever incentives or governance token they got as a reward for being there. So the model was, I think, at least to us, it was apparent that it was broken pretty early on. So we started tracking a metric which we called unincentivized TVL, which was we launched a product, here is the amount of assets that are under management in that product, here's the liquidity that's on chain for it, and that became like our North Star metric. So There are definitely instances where certain protocols with different tokenomic structures have a little bit more longevity to work with. I think Balancer is a really good example. So, we've been working with them for about a year on new asset management infrastructure, and one of the capabilities that we'll unlock with managed pools is being able to stake assets within that pool and earn BAL rewards as a part of their mining campaign, and then actually sell those BAL rewards and compound it back into the value of the pool. So, Balancer is an example of the VE tokenomics curve, kind of introduced us to it, but there are ways with some of those tokenomic models to squeeze out a little bit more yield, but whenever we're hashing out ideas or product development, our guiding principle is, incentives, liquidity mining programs. Those are not going to lead to a material change in how we decide on whether or not we do or don't use the protocol or capture yield from that in some way. Just because you might get a lot of users at first, it might attract a lot of interest, but it's really hard to break the news to your customers that the yield on your product is falling off by 50% because you ran out of governance tokens. So it's not the most it's not the best way to think about tokens in this way over the long term, because you kind of set your users up for a certain expectation, and then when you can no longer support that via some token emission schedule, you can just dissuade people from sticking around. So there are consequences from some of those incentive models, and we try to focus on our products. And our governance token has some unique attributes, but it's kind of like the orphan. Sometimes we forget that we have it, or we forget that we need to do something with it. And I think we're a few years away from any real value accrual given the regulatory setting that we're in. But there's a lot of different ways to play it. Programmable money can go a lot of different directions.
Well, something interesting about that too, for anyone out here that's looking at building something, like token design is a very interesting space because it's a new thing. Tokens are a new thing. I don't think people have fully wrapped their heads around them yet. And what's cool about it is I think they bring like 3 or 4 different dimensions that you see in the regular world, but in a new way on chain, because you've embedded a financial aspect to software that didn't exist before. But tokens kind of have an economic aspect in regards to the fact that they could be ownership in the network. There's also like a governance or a political aspect though, because you can vote the tokens and dictate which way things go. So networks have this decentralization spectrum where they start early on with governance design, which is very important to get correct. There's an inflection point at network launch when the network goes live and there's an infrastructure piece there. And then you go down the line and you're basically, if you're successful, you're operating a business through an open community. So it's co-op almost, right? And the boardroom is now community forums, which is interesting. So people get involved in different ways. And then the third piece to the token, which I don't know how this will end up playing out, but it is something that I'm keeping an eye on because there's some cool stuff you can do, is the utility side. So this is like traditional world, Starbucks rewards points. On chain, who knows? I think it's going to end up being something new. There'll be a new blend that we're not used to right now that someone will kind of strike on, and then everyone will start kind of going down that path. But I think it's an open space for anyone that's out here kind of looking at starting something.
Yeah, absolutely. And I've worked on tokenomics, for a number of projects, and I think a lot of what we've been talking about here hews to sort of tokenomics, right? And what you're doing with your token, or perhaps a token of another protocol that you're using, right? So I want to pull on that thread some more, right? One of the sort of clearest utilities, and perhaps the least risky from a regulatory perspective, although who knows, is governance, right? And this is a utility that in DeFi especially, most of these tokens have. And I think you could say that DeFi has really pioneered the idea of governance tokens and using them to run businesses, quite literally. So Dan, governance, DeFi, right? How do we create sustainable, right, governance? What are red flags in governance? How are we attacking this problem? There's so much to talk about. I don't quite know, right? This is a totally sort of new experiment, right? Maybe you can comment on, some of the good, bad, and ugly.
Yeah, absolutely. So like you said, there's a ton to unpack with governance. I think protocol governance at its whole is pretty much the decentralized portion of decentralized finance, right? Your protocol will be governed by the community rather than an individual or a group of individuals. And so governance today, I don't believe, is the end state of governance. And a lot of it today, unfortunately, is like signaling on Snapshot how you want the core team to act. So even when a vote does go through Snapshot, there's no guarantee that gets executed on chain. Many of these things are signals to the core team to actually execute things on the community's behalf. And many DeFi protocols that you think are decentralized, in truth, are not. And not to name names here, but I know Frax is a great example because today they aren't decentralized and they're open. Like the core team is open about that. I've had conversations directly with them, and they're like, "This is a problem that we're actively trying to solve because they are a multi-sig controlled protocol that is now sitting on over $1 billion that is under one multi-sig's control, and that's obviously an issue for numerous reasons." They can actually move these funds without anybody's approval, as well as if the government came knocking, they would be coerced into moving these funds. And so they're actually kind of pioneering a new model. They're taking the Compound's Governor Bravo contract and kind of putting a 6 of 11 multi-sig on top of that, where the 6 voters, so the majority, will be smart contract voters, and the remaining 5 are actual humans. So they'll first be the core team, but in the future could be elected or voted out by the token holders. So this kind of balances 2 major trade-offs between decentralization and development speed. Because as Porter mentioned, there is a huge scale with decentralization. It's one end is super centralized but very fast, and the other end is super decentralized but extremely slow. And so I really don't think we've found the end state of what decentralized governance truly looks like. But we do see a ton of innovation, like this Frax example, where it's this optimistic assumption that the 5 signers are going to be acting with the protocol's best interest in mind, and if they're not, there's a 2-day time lock before any action occurs that the token holders could then vote against. Or we see this MakerDAO approach. They're going through meta governance, so one large governing body with subdivisions also governing certain areas of the protocol. We actually see the Cosmos Hub, the Atom token, doing a very similar thing with, they call them councils. And we also see DYDX now doing the same thing as well with these subcommittees that are all working they're specialized individuals. And so, we are still very much in the experimentation phase of this, but we are seeing people and these protocols actually innovate, right? It's not just kind of this copy-paste model of okay, we'll just do this one token, one vote governance and go from there and see what happens. So again, I don't really think we've found the answer here, but it's great to see different protocols innovating on different areas of this.
Yeah. So Allan, I want to hear sort of the same. You talked about already, some of the challenges you faced at Index Co-op with governance, right? Answer the question however you want, or feel free to answer kind of my earlier question to Dan. But I would do you what's the ideal state for Index Co-op governance? If you could, right, what would be perfect in your mind?
Yeah, it's a really tricky one to get right, and I can't say we're at a perfect end state now. I think we're more of an equilibrium than we were before because a model where everyone works for themselves and no one is empowered to make decisions is a very inefficient model. It's very difficult to align on a product strategy, execute on that product strategy, adapt it, and implement different mechanisms or solutions. And so I would say that when we started out, it was very much it was an experiment. Is really what it was. It was let's start a DAO, let's power it with these index governance tokens, and then let's just let everyone decide what direction we want to go. And that brought in a lot of great people, a lot of really thoughtful contributors, and we did make progress, and we did gain some momentum. But what we found was that it was really critical for the community and token voters to empower subcommittees, working groups, teams, and go as low level as, here is the budget for this team for the month, here are their KPIs. If they don't hit them, then we reconvene at the end of the next quarter and decide if they get a budget again. And so it sounds like the boring parts of running a business, but we're still trying to find the right balance of how much is going to be subject to a token vote, and how do we empower high-impact people to go and do their job, to make hard decisions, and to build something that can not only last, but actually just create value for people. And so we're trying to find that perfect solution. I think there's a lot of experimentation going on out there, but I mean, even now, if we want to launch a product, it's subject to a community vote. If we want to deprecate a product, it's subject to a community vote. If we want to empower a council of contributors that we elect to make hard decisions about how we deal with regulatory issues, then that's something that we've decided to do. And so one thing that we've all agreed to is that it has to be flexible, right? We have to learn from all these other experiments that are going on, And then the other thing, this is semi-related, because a lot of our products are index tokens, they have governance tokens within them. So Aave, Uni, Maker, Compound, all these big DeFi protocols that are present in our DeFi Pulse Index token, those tokens within the index have voting rights. And we actually, as index governance token holders, get to vote as a block. So in terms of integrations and like on-chain interoperability, it's really powerful for us to be able to go and vote on, with a lot of voting power, what Aave decides to do on this, fork, or when they decide to deploy V2 versus V3. So there's a lot of really cool capabilities that you can unlock with governance. But it is, I want to say, like a community-driven sort of org. Will ultimately make the best decisions over the long run, but you have to strike a balance in how can we actually be effective and get our job done and build something while also being accountable and decentralized and true to the ethos of what we're building towards.
I think that was a really good overview and lessons learned sort of in a lot of ways. I've been part of DAOs that have realized slowly that you cannot, you don't want to go full decentralization, right? You never go full decentralization, at least not at the beginning. So Porter, I feel like this is something that must kind of drive you guys a bit crazy, as early investors, right, in a certain protocol. I feel like governance is something you guys take very seriously and, want to make sure you have a hand. Like you said, you invest in people, right? So when it comes to governance, maybe, tell us a little bit about how you guys assess the risks, or how you guys use that to your best advantage or to the advantage of the protocol. Are you typically getting these governance tokens? Are you using them, or does a lot of the governance that you drive happen off chain, right? Just with talking with founders, and how do you think about that?
Yeah, I think it's a little bit of a hybrid model. I mean, I personally think that the kind of that open governance is a bit of a sleeping giant, because I think this is probably one of the biggest innovations we've had in organizational design since the advent of the corporation. And for anyone out there that's a student of history, the Dutch VOC was the world's first multinational corporation that came into existence about, I think it's like roughly 400 years ago. And what it did was it enabled people to spread risk in a new way, which enabled them a substantial amount of predictability for funding for trade routes that they were basically executing at the time across the world. And it led to just this renaissance and incredible economic growth in the Netherlands. And so what's interesting about DAOs is I think it's an evolution of the corporate model in that you can leverage a lot of the strengths of open source communities. So you see like the classic examples like Microsoft Encarta versus Wikipedia. So Microsoft Encarta started, you had all these experts hired, and it was going to be the world's encyclopedia. And what ends up happening with open source systems over time is they're very volatile and immature early on. And so a lot of them won't survive because of that. But those that do end up gaining a community. And then when you can leverage open source expertise from self-selecting groups, usually of experts around the world, I'm always amazed by who joins some of these communities. It ends up just scaling like this. And so you create just this absolute beast of an organization that you just cannot do in a closed circle. So what we do on our team is obviously help with investing in the deal process, et cetera, but we also vote our tokens. So Web3, I think, is a new type of investing. I think it requires a new type of investor because you're an active participant in the protocol. So if we believe, and which we do firmly, that users are owners and owners are users, and we have this new hybrid function in Web3, then you have to participate. And so token distribution is really important for that because you want an equitable distribution of tokens so that you can have kind of these weighted communities to help govern something. Otherwise, it's not really a workable system. The last point, so we're very active. We're in the forums all the time, whether it's on Twitter or just posting, et cetera. One last thing I did want to note, though, is we're also very interested in new governing models because I think it's pretty clear at this point that the direct democracy model doesn't work. You don't want to go to a community of 6,000 people and have them vote on every single thing. So just like you hear that crypto or Web3 is speedrunning financial history, it's also speedrunning political history. And so we're starting to figure out, I think, representative democracies and then kind of these new interesting models that combine kind of aspects of corporate governance and aspects of civic governance, and there's a difference in the stack, right? If you're a layer one, it's probably more of a public infrastructure good than if perhaps you're an app built on top, which might resemble a little bit more of a private, well, not private, but a publicly owned business. So you have different kind of constituents at each level, and that's something that we spend a lot of time looking at and evaluating.
Awesome. That's really exciting to hear, that you guys are taking such an active role, and, how exciting to be able to go back sort of the drawing board and be like, what do we even want governance to look like? What do we want corporate governance to look like? We can play with these models. We are running out of time, unfortunately, so I wanted to ask this question. I recently watched an interview with Kevin O'Leary, Mr. Wonderful, who's now a huge crypto bull, right? And this was a pretty recent interview. And in this interview, Kevin O'Leary compared crypto to, right now, to the pornographic age of the internet. He said basically crypto's in its porno age. Everything is porno, right? But we're going to get there, right? So I bristled a little bit at that. As a Web3 native crypto user, I've used DeFi for plenty of stuff, but not all of it's impulsive, right? So I would like to hear from each of you, and start in whoever wants to go first. Go ahead. Like, are we in the porno age? Are we in the porno age in DeFi? Are we in the porno age in governance? And if not, are we far away from that? Where are we in this spectrum, right?
The compliance team's going to kill us.
Yeah, about to say. I don't know if I'm prepped for this one. I will say that you see a lot of just like silliness and experiments and nonsense and noise, and there's all these things that definitely obfuscate the actual value. Like, what is at the core of Web3? What's at the core of crypto? What's at the core of DeFi? And there's, again, if you can try and find the signal in that noise, it can be really encouraging. And I think that most of the people I know that have made the leap and have left the careers and have started to build in this space, you're definitely like perturbed by all the nonsense that's out there that people think of. It's what they, your average person has already drawn a conclusion about the space and what it means. And past that point, though, once you really get into it, you find the people that are principled, that are in it because they believe it will make the world a more equitable, accessible, and just open place, more so than it is now. And I think that's the encouragement that I usually need to not believe all the noise out there, that it is just all scams. And that's difficult to overcome, but the internet really was. That was the primary use when the internet was initially launched for the open public, was pornography, and then online gambling was another one of the big use cases. And if people wrote the internet off then because it was being used for bad things fundamentally, then I think we'd be in a lot different world than we are in today. So if people can just use that, anecdotally, then there's a lot that we can build. That's pretty incredible.
Cool. Anyone else want to tackle that?
Chris on our team has a great quote, Chris Dixon. I'll keep it super short, but it's something I've always found really insightful. He said, often in tech cycles, the first innovations will show up in these ridiculous, like, metaphorical vehicles, whether it's like a Bored Ape, or we got some Bored Ape folks up here. They're great, though. Everyone should chat with them. Whether it's a Bored Ape, or whether it's any of these types of NFT projects, or things that just on the surface might look like this fun kind of offsetting thing that you wouldn't take seriously, they often mask deep technological innovations, right? And with NFTs, it's simple, right? It's digital property rights. Like the next generation is going to think it's crazy that we didn't have cryptographically kind of secured or defined digital property rights the way that it's coming. And so that's the one thing I would kind of leave everybody with to answer the Kevin O'Leary quote, is don't confuse the ridiculous things in the vehicles they come in with the underlying huge tech shift that's occurring that they're kind of a Trojan horse for.
Awesome.
Yeah, strong agree there. I know we're pressed for time, so I'll keep it quick. But I think we're close. I really do. I think there's a couple key innovations that we're still missing, right? I've talked to a couple crypto native hedge funds, and these guys on their own are like very on chain. They know what they're doing. But when it comes to like bringing their funds money into crypto, it's like, okay, well, how do we do this? Like, there's still big reporting compliance pieces that we're missing, right? So if a fund is going to use like an on-chain protocol for leverage, like if they use Gemini, for example, Gemini is going to give them this clean, neat monthly reporting of exactly everything they need to know to take to their compliance team and make them happy. And that doesn't exist on-chain, but we're probably only one product cycle away from that. So I am pretty excited for what the future and what's to come. And it's pretty hard not to be bullish once if your nose is in the ground and you're watching all the innovation that's happening. It's pretty exciting to see what's coming, and I do really think we're close.
Awesome. I think maybe we have time for one more question, Jack? All right, awesome. So, yeah, we can keep going. Obviously, we could keep going for hours. So many topics we haven't really dove into yet. But I would like to hear, maybe this is a nice thing to close on, from each of you, right? What do you think people can do? What can each of us do as users, as product builders, as investors to contribute to a sustainable DeFi ecosystem that we all want to see?
I think the best thing that like an individual investor can do to contribute. So if you own like DAO participation is a huge issue, right? And I think participating in DAOs is a huge way to do that. And being educated and providing insights for the DAO is incredibly valuable. So one of my personal favorite ways to become educated and be able to provide these new insights is like studying on-chain analytics. And a great way to do there's two amazing free tools, both Dune and Flipside. Aggregate a ton of blockchain data and make it free to access for anyone. And a lot of the people here are Georgia Tech students. I know you guys can learn SQL. It's not that hard. I know all the crazy work you guys do. So leveraging Dune and Flipside to kind of like understand what is going on chain and how smart contracts are communicating with each other is super beneficial. And then taking that knowledge to participate in DAOs is a great way to contribute to the sustainability of this ecosystem.
I would say go build something, or join an early startup. And one piece of advice I would have is if you're looking at it, there's so much stuff that needs to be built, and it's just kind of overwhelming. You might not have an idea yet. A great way to learn is to join an early startup and figure out kind of some of the problem points, and then go attack them.
Awesome.
And I think there's a couple of superpowers for DeFi, but composability and transparency are two of them. And I think that the more people just wrap their head around composability and what it means and what you can build with it and how incredible it is, the more you see the opportunity. And anytime you are just curious enough to get started, it's always fun to fall down the rabbit hole. That's a phrase that we use all the time, but there's no way of getting out of it once you're in it. And then also, just to second what Dan said, it's like as transparent of an ecosystem as you could get started in, whether that's just combing through Etherscan or Dune or Nansen or any of these platforms that exist. Getting started is so easy, and hopping in a Discord, going to a community call, joining a Twitter Spaces, there is transparency is at the core of everything that's happening here. And so if you can lean into that, you can learn a tremendous amount if you're just willing to deal with a little bit of chaos.
All right, awesome. Thank you guys so much. A great way to close out the first day of Web3 ATL, and thank you all for being a great audience.